Monday, the 10th of August, 2026, and just one clean candle could change the euro story for weeks. Euro to US dollar is flirting with a downward trend line that has capped every rally for months, and this morning FXStreet published a note calling it exactly, on verge of downward trend line breakout. If you have been waiting for a credible shift from bear trend to bull revival, today is the session that might deliver it. But here is the catch, a breakout is not a straight line trade. The same chart that teases buyers with 1.1590 and 1.1660 also keeps a loaded gun pointed at 1.12 should this test fail. So we need to move beyond headlines and understand what is actually driving price right now. Let us connect the dots behind the move. First, lower energy prices are a direct tailwind for the euro area. European natural gas costs have retreated sharply, improving the terms of trade and taking pressure off the European Central Bank. Second, as Forex.com highlighted 4 days ago, the long-running downtrend resistance already snapped on a daily close, and that event has been paired with peace deal speculation that lowers the continent's risk premium. Third, the US rate story is stalling. Markets have pruned Fed hike expectations to just 42 basis points by mid-2027, which means the dollar's yield advantage is not accelerating. Add in the fact that buyers have been defending the 1.1490 floor religiously, and you get a supply-demand equation that finally favors the euro pushing higher. Price is not just respecting trend lines, it is respecting zones that traders can actually trade. The near-term support stands at 1.1490, reinforced by the 1.1480 pivot. This band is the buyer's last stand. As long as it holds, the structure favors a move towards the 1.1590 resistance, where sellers will stage their first real defense. Above that sits the real prize, 1.1660, a level named by Forex.com as critical support in the old range, now acting as a hurdle. Confirmation above 1.1660 would turn the weekly chart positive and bring the 200-day exponential moving average into play. But if 1.1480 cracks, the floor disappears and we are not looking at a dip, we are looking at a trend shift back towards the 1.12 to 1.11 region. That is the binary game this morning. While we focus on the euro, the dollar side is sending its own signal. The US dollar index is currently testing a range breakout at 100.45. A sustained push above that level would target 101.61 and then 102.66, which by default pressures euro to US dollar lower. So we have two opposing breakouts developing simultaneously. The risk here is a fake out, euro to US dollar briefly pokes above its trend line, but DXY strength drags it back inside, trapping late buyers. That is why today's London FIX and the New York Open are so important. Volume and follow-through will tell us which breakout the market truly respects. The evidence tilts cautiously bullish. The multi-day floor at 1.1490 has held, the 50-day moving average is sloping upward, and the macro tailwinds of cheaper energy and a less hawkish Fed are real. If the breakout confirms with a daily close above the trend line, the path to 1.1660 opens quickly, and swing traders will likely target that level within a week. However, I am watching the DXY 100.45 level just as closely. A failure on euro to US dollar to hold above 1.1490, especially if DXY pops, would negate the setup and activate the 1.12 bearish case. Right now, it is a verify, then trust environment, not a jump in blind one. Your action plan today is crystallized by these levels. Watch 1.1490 as your line in the sand, treat a confirmed trend line break as a trigger toward 1.1590 and 1.1660, but keep an eye on the dollar index at 100.45 for divergence. The euro's downtrend may genuinely be ending, but markets love to trap the impatient. Stay precise, wait for the close, and let the chart prove itself before you commit heavy size. That is the disciplined way to trade a headline like Breakout Verge on the 10th of August, 2026.